Our first question was from Austin, and he has an idea, but wants to know other ideas on what to do with a profitable long call position. So he bought a call that has moved up in price, and he has an idea of managing it, but he wants to know other ideas there to help manage it as well. Here's the direct question from Austin. I own WFC Wells Fargo long calls with a 40 strike for June expiration. He purchased these months ago in anticipation of recovery. Now WFC is on a tear. He's trying to plan his exit. Rather than sell out or just trail out, I'm intrigued by structuring a butterfly, selling 2 times 45 calls for June and buying 1 time the 50. And can you help weigh the pros and the cons? We have 10 calls, the price of $1.38. No problem. So where does this stand right now? Let's assume a date. Using the options research tool, we were able to go back in time, and we were able to see, of course, we were able to see, of course, the prices, historical values for the option and implied volatility over time. So we're just going to assume a January 12th, 2021 purchase price. It was around 131 at the close. So let's say that we bought to open 10 June 40 calls at 138. This morning at around 11:30 a.m. when I got the email, WFC was around 43.13. June 40 calls, 63 days to expiration, we're at 390. Sell to close, we'd get 3,900. Cost basis was 1380. So we'd have a profit of 2520 or 182.6%. Tracking the position on power options, we use the portfolio tools and we go to position actions and then position analysis. The position actions menu is also where you could close, roll, edit, adjust, or expire positions or assign them as well. In that case, you can do all of that through the position actions menu when you're tracking a position in the portfolio. But of course, as we linked to the portfolio fields, we saw our current liquidation value at that time is about profit of 184.4. And this profit here is if the stock stays at the same price to June expiration, we'd lose about 60% of profit due to the time value decay. And we do see some rollout opportunities that appear for this position as well to adjust it, manage it, take out some of the risk, if not all of the risk, and more. So let's take a look at one of those no risk adjustments. One of the ones the portfolio was showing is we could roll up the call. We could sell to close our existing call for about that 390 I mentioned and buy to open a June 42.5, move it up in strike for only $2.30. Well, this would take about $1.60 off of the price, so we now have a no-risk position where we can't lose if the stock falls, and we still have unlimited upside profit potential for the call to continue to move up and gain in value as well. But the approach that Austin mentioned is also a no-risk potential. So the idea here was on his long call, down here at the 40 strike, it's now in the money with the stock bouncing around at 43.24 or so. We could sell 2 contracts of the June 45 call for $1.25. Now that would bring in $2.50, but with selling 20 contracts against his 10, we'd take in $2,500. And then we'd buy 1 or 10 contracts, in this case, of the 50 call, higher up in strike, to finish the butterfly. And this would cost us about $32 per contract. Now, this creates a no-risk position where with a 10-contract trade, we'd have a guaranteed profit of $800 to the downside, $800 to the upside if it goes above that higher strike call in this case, and a potential high max profit here at the peak. Essentially what he did is he had a long call. He's going to create a bull call debit spread when he sells 1 of the 45s and then complete the butterfly by selling another 45 call and buying the 50. That's essentially a bull call debit with a bear call credit spread. similar to an iron condor or an all-call condor, but we're at the same strike. Now, which is better, and are there others? Well, the basic review of what you can do with a profitable long call now is, of course, number one, do nothing. Leave the position as is. You're expecting more growth over the next 63 days to expiration. Simply close the position. Take the profits out of the position and then move on. Look for another trade. Another option is to sell to close half. He has 10 contracts that have a high profit on them right now. He paid $138, they're worth $390. If he sells to close 5 contracts at $390, he has a guaranteed profit here to the downside with still 5 contracts at the 40 strike with unlimited upside. Without making an adjustment, we could simply sell a call against it to create a calendar. Calendar spread or diagonal call spread, what some might consider a poor man's covered call. We might just go 14 days out to April 30th expiration, generate another 70 or 75 cents against our cost basis. We showed rolling up the call. We'd go to a higher strike here, but cancel any exposure to the downside, lock in a very small profit, but still have unlimited upside to go with no chance for a loss. We can combine different ones. I could roll up the call and then create a calendar to have even less exposure on the position and still high potential profit. And of course, we could get complicated. We wouldn't keep this simple. We could sell to close half. Sell those 5 contracts, have that no risk long call. Then roll the remaining 5 calls up to 42.5 strike and then create the calendar. Or of course, create the butterfly or the condor. Now, let's take a quick review of those and discuss the pros and the cons. The first 2 are obvious. Do nothing. Stay in the call. What are the pros? Potential for more profits, not worried about any adjustments. What are the cons? Well, they're obvious. The stock could reverse and we could have a loss. We didn't do anything to reduce the risk, cost basis, or exposure, and we have a potential for a more rapid time decay accelerating as we only have 63 days left to June expiration. 2, close the position. Take the profits now. Sell to close all 10 contracts at $390. We'll take in $3,900. The original cost basis was $1,380. So we have that profit of $2,520 or 182.6%. The pros, take the profit out of the position entirely. The cons, we're out of the position. We may miss further upside if the stock continues to go up in price. 3 and 4, closing half. We own 10 contracts at $1.38, paid out $1,380 to enter this long call. Sell 5 contracts at $390. Again, that was today at 11:30 this morning. The prices sort of pulled back later in the day. Remember, this is just 11:30. So selling 5 contracts at $390 would bring in $1,950. So that means that now we've pocketed $570, and we're still in 5 contracts that leave the upside open in this case. It's a pretty good position to be in, but we're only locking in 22% of the total liquidation value of $25.20. Right? We're only locking in $570, but that's pretty good, and we've left the upside open. Creating a calendar. We'd look shorter term. We have 63 days to go, so we might look 14 days out in time, sell it a 2 to 3 week out of the money call to give us some appreciation. The stock was around 43, kept bouncing around between 43.20, 42.50, and so forth. But we could look to sell to open the 30th of April, 44 calls for 75 cents. Okay, what are the pros of doing the calendar? We get $750 against our cost basis, meaning the risk would drop down to about $630, half of the exposure that we have now. We can continue to roll these calls. If we get near April 30th and the stock's right around 44 or just below it, this expires, we could now sell a May 13th, a May 14th call, for example, and then sell another one 2 or 3 more cycles before we get to June to continue to lower the cost basis on this position. Gives us a peak profit of $38.47 on April expiration or 610%. Cons to this approach is that we now have a capped upside if the stock really runs, and we can still lose in this case. But take a look at the next ideas. We can start combining these. Well, the simple one is just rolling up the calls we already showed. Cost basis of $13.80 on 10 calls. We sell to close those and get $3,900. Buy the 42.5s at $230. So essentially, we're putting out $3,680 between these two, getting $3,900 back. So we have a credit of only $220. Well, we did cancel the risk on the position. We left the upside open. But in this example, not as good maybe as selling half and taking that $570. We're only getting a locked-in profit of $220 with upside open, which is great, but that's only about 8.7% of the total $2,520 we could have for closing the position right now. Of course, we can combine what we just saw. We could roll up the call to have that cost basis of $220 guaranteed profit with unlimited upside. Now sell the April 44 call for 75 cents, take in $750. That leaves us with a position that's guaranteed to make $970, and on April 30th, a peak profit of around $3,600. But again, it's capped upside, but now we are locking in 38%, but only 38% of what we could get at liquidation right now by simply selling to close the call. But this is an April expiration, potential to increase profit by another $1,100 or so, or continue to roll the position with the guaranteed profit in place after we cross April 30th expiration. We still have the long out to June, so we have a few more right cycles we could continue to sell against that. All right, here's the big one. And I know it's complicated, and it's a lot. It's not keeping it simple, but it is an opportunity. Combine 3, 5, and 4. Sell half. Lock in that profit of about $570. Sell to close 5 contracts at $390. Collect $19.50 against our cost basis. Guaranteed profit of $570. Roughly, we have a credit of $1.14 for our remaining 5 contracts. Now we roll it up. We sell to close those 5 June 40 calls at $390 and buy 5 June 42.5 calls at $230. That locks in another $800 on the position. Then sell to open 5 April 44 calls at 75 cents, which effectively gives us $375. So now the guaranteed profit to the downside on the position is $1,745 after combining 3, 4, and 5, selling half, rolling the remaining half up, or you could say selling all 10 and just buying 5 at the higher strike price. You could look at that either way, and then creating the calendar. Now, this is a guaranteed profit to the downside of $1,745. That's 69% of the profit we'd get just by liquidating right now. But we have the potential to make closer to $3,000 if the stock continues to come up. And this is just on April 30th, mind you. This is not in June. This is just on April 30th. So it's about a 24% increase of a peak max profit as opposed to liquidating right now. What are the pros of this combination, even though it's a little bit complicated? Selling half, rolling up the remaining half, and then creating a calendar. Well, you get a good guaranteed profit to the downside, even if our stock pulls back to, say, $40 per share. Let's go here. We're only a little bit below the max guaranteed profit we have if we liquidate right now. It's pretty strong. And we don't have to stop this trade in April. If WFC stays below 44 and this call expires worthless, we could then look to sell 2 weeks out into May, get another 70, maybe 75 cents, and increase this status by another $700 or so, guaranteed profit, and increase this status potentially as well because of the lower cost basis. The problems here, the cons of any calendar, you have a peak profit, capped upside, and as the stock moves above the short call at that near-term expiration, you start to pull off from the peak because your short option delta here in April is quickly going to a delta of 1, and the June option at 40, even though it's deeper in the money now, might still be a delta of 0.8, 0.85, or 0.9. But this is going to go to 1 quickly as we get closer to the 30th of April. So that's going to peter away here from some of that max profit. But still, the stock ran up to 50. We're still making about the same amount of value here as we were if we just liquidate right now. But here we're guaranteeing profit also in this case. Austin's plan, not a bad plan. It's a good plan. We just want to show the comparisons. It's also the no risk adjustment. So creating the butterfly. Again, sell to open 20, June 45 calls at $1.25. That takes in $2,500. Buy to open 10 of those June 50 calls at 32 or $320. Again, you essentially create a bull call debit between our existing 40 call and 10 of the 45 calls we're selling, and a bear call credit spread between the remaining 1045 and the 1050 calls. This does mean that we'd have to put on hold in our account $5,000 to cover the strike difference of that credit spread. But this does complete the call butterfly. The max profit at June expiration is $5,800. The guaranteed profit if the stock falls below 40 or suddenly shoots up above 50 at June expiration is $800. That's a guaranteed profit. This is a good risk-reward ratio, but keep in mind this max profit of $5,800 occurs here and only there. Only if the stock is trading at $45 at May expiration. That's the only time that happens. And the tail off, as you can see after that in a short movement, if we just move up 2 points from 45 to say 47, we're down to 3,200. We gave up about $2,600 in profit. Why is this happening? Well, if the stock's trading right at 50 in this butterfly, here we have our bull call debit spread, 40 to 45, which means if the stock's trading right at 45, we can effectively buy shares of stock at 40, sell them at 45, and we get $5 or $5,000 back. This butterfly is done at a credit of $800, so that 5 points at the peak plus the $800 net credit is our maximum profit. The other call essentially and the 50 call would expire worthless. Bear call credit spread right at the money. But of course, as the stock starts to move up above that, what are we doing? We're giving back on the other 10. We have to buy to close these other 10 contracts at the 45 strike that aren't covered by our 10 at the 40. And we can't use this one yet. So that's causing the loss to happen as you keep going up in the all-call butterfly. And of course, max loss but guaranteed profit occurs here. The stock's above 50. Now, don't want to overcomplicate it, so I'm just going to go through this real quickly. We could do what we just did in 7 and then do the 8 idea. We could sell half and roll up the remaining half. Sell to close 5 of the June 40 calls. Then roll up to the June 42.5. So that structure gave us the guaranteed profit of $13.70 in this case, or a cost basis of $2.74 credit for our remaining 5 contracts at the 40 strike. Now, I did sell again in this example the 45 calls, 10 45 calls. We only have 5 calls remaining, so we're going to sell 10 at 45 to collect $1.25 or $1,250. And we're going to buy 5 at 47.5 strike call, which is going to cost us $350. But this combination of $13.70, $1,250 minus $350 gives us a guaranteed profit of $2,270, almost the same as we have right now if we sold to close the position, with a potential to make a max of about $3,500. why is this max profit so much lower than the standard call butterfly we just showed without adjusting the first original long call? And it's because I kept it at even strike prices. After we rolled up to the 42.50 after selling half, even though we have a higher guaranteed profit, the debit spread value is only 250 if the stock's at 45, not 5 points or 5,000 as we had before. So we're not gaining as much profit there in that case. We do still have to put up a margin requirement of $2,500 to cover the bear call spread between the 45 and the 47.50 strikes. Okay? But it still gives us that guaranteed profit of $22.70 and a max profit of $35.20. Now, as always, let's just try to table that real quick. Number one, do nothing. What does that do for us? Leaves us with an exposure of $1,380, a chance for 100% risk, but we still have unlimited upside profit potential. Let's be honest. We're doing one of these other ones right now. We're not probably considering that. Number two, close the position. Take in $2,520 profit and just move on. Not worry about time decay over the next 63 days, not worry about any other adjustments or watching a butterfly or watching a calendar spread. Just take it and go. The sell half idea I kind of really like, honestly. Not as much profit guaranteed as I'd like, but we sell half. We sell half the positions, we sell 5 calls, we get a guaranteed profit of $570. We pocket that now. And we remain with unlimited upside profit potential, and later on we could still decide to convert it to a calendar or another position if we wanted to. Straight calendar, selling the 30th of April, 44 calls. Other calls could be used, we're just using this for the example. That cut the risk down in half, but we still have a risk of $630. But there was that peak potential profit, $3,847 or so. The stock was trading right at $44 on April 30th expiration. Rolling up the call, all 10 calls, not closing half, rolling up the call, all 10. Sorry about that. We'd roll up to the 42.5. We have a guaranteed profit of $220 and unlimited upside profit potential still moving on. But again, this was only about 8.7% of the profit we could take in right now by closing it. And it's half the guaranteed profit we would take if we sold half of it right now. Roll up as we just showed in number 5, and then create the calendar. Combine sort of 5 and 4. That increases the guaranteed profit to $970 with a peak profit if the stock, still using that 30th of April 44 strike, profit around $3,637 potentially. But a guaranteed profit of $970 is about 35% or so of the $2,500 we could take in right now. The madness, number 7. Sell half from number 3. Roll the call up from number 5 and create the calendar from number 4. High guaranteed profit, $1,745. Potentially higher peak max profit at $31.38 on the 30th of April. If Wells Fargo is trading at the 44 strike. Not a bad position at all. Austin's original butterfly, fairly strong. Guaranteed profit of $800, pretty close to what we get with number 6 here. Okay? And again, a max peak profit higher than all the others, $5,800 in June. 63 days away. If the stock happens to be trading right at $45 per share. It's always something to remember with these butterflies and peaked profit and loss is the maximum occurs at one point, and as you start trailing away from that one direction or the other, you're not making as much. You're making maybe equal to what you'd see here in this range for the calendar, in this range for the calendar as well. So in that case, we've got to consider, is it worth it to take that chance? But the ROI, the risk reward here, is pretty excellent, isn't it? I can't argue that, and I'm not arguing that. Guaranteed profit of $800 on the outside wings. A third? Yeah, about 33%, 30% of what we could take right now if we just closed the position, with the potential to make double if and only if the stock's trading at that particular point 63 days from now. Fairly long time frame. Now, 8B, or 8A as we call it, combining 7, that mix of selling half, rolling it up to the next strike price, and then creating the butterfly, gives us the highest guaranteed profit with a slightly higher return, or even return to number 6, slightly higher return than number 7, but below the max. And again, it only occurs if the stock's at 45. And because in this example, we were only using 2.5 point strike differences instead of 5, it really peaks quickly. So as the stock goes to 47, or, above 45, it goes to 46 or it goes to 47, now we're just down, instead of making 35.20, we're closer to the 22.70 with just a 2-point move. This butterfly that Austin was looking at gives a wider range of profits between the strike prices, but only has a guaranteed profit of $800. So which one's better? Well, that depends on what your goals and your targets would be for the position itself. What are your goals and expectations for Wells Fargo going forward? We just wanted to share some of the potential ideas you could use to manage a profitable long call. Everything from just simply selling a call against it. Always consider selling half of it depending on the return that you have. Never hurts to consider rolling up the call if you can lock in some profit, and then combining some of those as well. Butterflies, you can probably tell I'm always kind of iffy, especially going 63, 64 days out with a peak potential profit and loss chart where saying, hey, this is the best ROI. Potential for a $5,800 profit. Actually, this one's probably closer to 1-to-1, but there's no risk. I mean, it's a guaranteed profit of $22.70 with potential to make more up to $35.20. This is a guaranteed profit of $800 with the potential to make $5,800. So that's very strong. But that only occurs at one exact point close to or on June expiration, which is 63 days away. So that's just a quick wrap up with a lot of math to make it complicated, of 7 to 8 ways you might consider managing a profitable long call in those positions. And of course, as always, we'll have this presentation separated out and recorded for everyone so you can take a look at that later on.